Well, for more on what's happening on the markets, joining us now is Brian Belski, Chief Investment Strategist at BMO Capital Markets. Brian, thanks so much for joining us today.
Thanks for having us, Jacqueline. Good afternoon, Canada.
So what do you make of the move that we saw today in those 10-year yields?
Well, the really only tick that we saw above 5% was before the market opened. So, and then the market opened and we start to see treasuries rally again. It was very similar to what we saw on Friday. And we do believe that from a risk asset perspective, if things get worse in the global insecurities, let's call it out there, geopolitical events, I think you're going to see more and more people come back to buying bonds. So I think people have to kind of take two steps back, Jacqueline, and remember that the average 10-year Treasury since 1990 is 5.8%. The average 10-year Treasury since the Great Financial Crisis is 2.7%. And I know I'm throwing a lot of numbers around, but let's just take it a step further. The average 10-year Treasury going back to the 20s is 5%. And so one of the biggest themes of investing is this return to normalization. And I think we're returning to the normal. There's no doubt that we're having reactionary type trades in terms of assets and strategies over the last 30 to 45 days. Just look at the high yield sector. But we think much of that is already played out.
Speaking of taking a step back, Brian, you have a graph for us looking at 1 year of this bull market, but it's showing lower gains compared to previous ones here. I wonder if you can just give us a sense of what's been different this time around or what we should read from this.
Well, I think what you should read is it's a little bit different, especially considering the exhaustive type of activity that we saw leading into this new cyclical bull market. Remember, we're believers that this new cyclical bull market is part of at least a 25-year secular bull market that started in 2009. I think the market and investors are wary of huge directional changes. And we do think, given that we're coming off of a base of, let's call it higher than at least normal interest rates the last 5 years, I think going back into like a 9 to 11% type return of the markets make a lot of sense. And I think that's where we're at.
We've got another one that shows performance, I think, on the second year here, year one versus year two of bull markets. Can you tell us what this is illustrating?
Well, I think it gets to the notion of, I think, of our overall theme to normalization. We've said for a while now that over the next 3 to 5 years, we're entering into this period of high single digit to low double digit type gains. And if you take a look at the year two of the bull market, it's right in line with where we think markets could potentially be in 2024. We keep talking about the returns of the market following a very nasty cyclical bear market in the early 90s, like 1994. We had a similar type pullback, Jacqueline, where we had a commercial banking and commercial real estate crisis in the United States, but the Fed was still raising interest rates. Kind of sounds familiar, doesn't it? And then the Fed pivoted really heavy in January 1995, and then it produced that 11% return. So we think that markets are in a lot better shape than most people think. We think history is going to, in normalization, is kind of coming back on the side of markets, and very important data point to be considering.
We're going to hear from the Fed, speaking of the Fed, in about a week or so, well, a little over a week from now, the end of the month. November 1st, actually, the end of October, November 1st is their meeting. What do you think we could hear from the Fed this time around?
I think he's going to continue to talk about data dependency. He scared the you-know-what out of people in his most recent comments. So I think he achieved what he wanted to achieve in terms of any kind of exuberance with respect to asset prices. And clearly, we are starting to see a bit of a slowdown. Let's call it, even though the market in the economy, for instance, has been very resilient, especially on the employment side, the consumer has been slowing down a little bit. So, and especially considering the geopolitical risks out there, it probably behooves the Fed to stay on the sidelines.
And what about the Bank of Canada? Because we're going to hear from our central bank first this week on Wednesday. What do you think we might hear from the Bank of Canada? Do you think the Bank of Canada is done at this point?
We think we do. Our great economics department does. And I think things are slowing down even a little bit faster in Canada. And remember, too, the trend is that Canada usually leads the U.S. in actions. They they hike first, they cut first, and they pause first. And so I think given the more cyclical nature of the economy and the stock market, we would venture to guess that Canada is going to be on hold as well.
Yeah, speaking of the stock market in this country, and you know what you're sort of interested in or looking at right now, you're looking at Canadian small caps. We've got a chart of yours again here to illustrate what you're watching. Can you give us the rundown here?
Canadian small cap stocks are an interesting set of companies. We have at BMO had a portfolio that has been run since the early 80s. We took it over 11 years ago when we came to BMO. And it's an interesting group of companies that become these kind of incubator companies into large cap companies, obviously small to large. Thanks, Brian. That makes sense. However, from a longer term perspective, this small caps in Canada actually outperform small caps in the US. I think principally because they're more tied to what actually the index looks like, meaning more on the resource side, especially oil and gold. But there's still a lot of great non-oil and gold companies in that small cap index. We think there's a tremendous amount of opportunity with I think, an even better cross section of value and cyclicality relative to large caps.